go as far as to say that there is no chance. The guy who invests in 5 different large cap funds will never be able to become financially free by the age of 40, 45, 50.
Okay, so you talked about the good sectors. What are the bad sectors which I should avoid?
Like oil companies.
What about automobiles?
I actually have a controversial opinion about automobiles. I think that India's roads need to improve before we can produce automobiles at the scale.
Back in college days, one of these guys introduced me to IPL betting. Now every day we were taking at least 2 to 3 bets and we watched every single ball like our life depended on it, and then ended up with the negatives of these. And then the next day we went again. I have Microsoft, Google and Tesla. Would it not be a smart decision to blindly invest your money in these 3 companies?
Not necessarily. The public is most often wrong about the future.
I am somebody who can invest 20,000 rupees per month as an SIP. You tell me, how do I divide the money across different sectors?
I think for the goal of creating massive wealth, like you mentioned, is to not have more than.
In today's episode, we sit down with Tejas Khoday, the visionary founder of Fyers, one of India's leading online stock broking platforms, empowering over 1 million users to take control of their investments. Tejas, a seasoned entrepreneur and an investor, is passionate about democratizing access to the stock market and providing retail investors with the tools they need to make informed decisions. He's been a driving force behind Fyers' success. You'll learn why most retail investors in India are actually just gamblers, and Sharan's story that will make you rethink everything. Why your mutual funds might be quietly killing your dream of early retirement. How Tejas built a 300 crore brokerage from scratch without a single rupee of funding. And the 3 psychological traps that blow up most traders' portfolios before even they know it. Stick around, this one might just change how you see the markets.
Today, you're the CEO of a company called Fyers, which has more than 1 million users currently trading on that platform.
Right.
I wanted to understand exactly what is the business model. How does a brokerage or a trading app actually make money? Because this year you're about to get 300 crores of revenue,
Right.
with about 10 lakh people trading on your platform.
That's right.
So can you explain how it works and what exactly does Fyers do?
So Fyers facilitates both trading and investing in the Indian stock markets through our app, right? We have an app and a web app, which is a mobile app and a web app. So essentially how it makes money is by charging a very small fee per transaction, and the volumes make up for the fixed costs and the variable costs that a business like ours has. So yeah, essentially it's a very straightforward.
Can you put some numbers to it, like so that
So
I
we
can understand?
charge a flat fee of 20 rupees per executed order.
This is
so each time-
across any trade? Cash
Across any trade. So for instance, if you want to buy stock, right, you're going to be levied a fee of $20 maximum.
Okay. So this is any stock?
Any stock. Right? Any stock. Or let's say you're trading intraday or trading in the futures and options market. For anything that you do on the platform, you will be levied a flat fee. So it's very simple, straightforward, and not hard to understand at all.
Now, trading is not the same as investing or betting on a company. Trading is something different, right? And I want you to explain that nuance to the audience, because a lot of people think that buying a stock is the same as trading, right? And when they hear the word trading, they think that anybody who is investing in stocks is a trader. But that's not the right definition, right?
Yeah.
There are 2 different types of investors. So can you explain exactly what does a trader try to do? Because as an investor, I'm investing in Reliance. I believe Mukesh Ambani is going to get even richer, so I want to be rich with him.
Right.
What is a trader really thinking? What is they betting on?
So the difference between a trader and investor is essentially time frame. The time frame in which a person is operating is what differentiates an investor from a trader. For example, a trader is thinking short term inherently, meaning that he's trying to make or maximize returns in a very short period of time, move on to the next opportunity. So in general, it's a short-term mindset. Whereas for an investor, it's supposed to be a long-term mindset. If you ask me, the vast majority of the retail trading audience in India, barring the mutual fund investors, are actually traders, not investors.
Really?
Yes, they're investing. They think they're investing, but they're actually trading.
Can you go deeper?
Because if they're willing to sell out a stock because it did not do well or because some news broke out 3 months after they bought it, it's really not an investment.
Right.
Investments should last much longer, much longer than 1 year, ideally speaking.
Right.
LTCG kicks in only after 1 year.
Right.
Long-term capital gains tax, everything before that is considered short-term even by the government. So the point I'm making here is that an investor needs to think like they're investing in a business and not in a stock. But most people are investing in a stock. They think they're investing in a stock, but if they see a 50% gain in the stock that they've apparently invested in, they'd be happy to cash out and go buy something that they always wanted to or go on a vacation.
Right. So that's like a trader mentality.
That is a trader mentality.
And most people are hardwired to think like that.
Yes, I think as a society, we are headed in that direction.
Would you say it is similar to sort of like the feeling that gambling gives me? Because when I go to a casino and I see that my 1,000 rupees has become 2,000 rupees, I can't stop playing. Now I'm thinking I like the feeling of getting that instant money, which was not possible anywhere else. And I'm kind of hooked to that feeling. Similarly, when I trade and I see that overnight my money has grown by 50% or 100%, I like that feeling more than anything.
Right.
Do you see there is some correlation there?
There is. If you don't know how to handle your mindset, then you're going to become subject to this. Because at the end of the day, I strongly believe that people don't possess money. Money possesses people.
Okay.
And companies that have understood that, or industries that sort of have figured this out, constantly nudge people to behave. They're able to affect people's behavior. Like take credit cards, for example. Right? You rake up all these points by shopping on the card, and all of a sudden they will nudge you to travel to some country.
Yeah.
Because of a discounted offer, and you have all these points with which you can pay for that. And then how are you going to reason with yourself? Any average rational thinking person would say, oh yeah, I'm just going to take this flight and plan my vacation to this place, right?
Yeah.
But what if you did not have those points? You would probably not go.
No.
So money possesses people.
Interesting. It also reminds me of a story of myself back in college days. I had just moved out of my home to study at a college called RV College of Engineering, which is in Bangalore.
Yeah.
And I was staying
South
at
Bangalore.
Yes, it was in Kengeri, South Bangalore. Yes, on the way to Mysore. And I had moved into a PG, and the PG had all kinds of people, right? One obviously were my friends, but there were also this set of rich Delhi boys who I immediately became friends with, right? Because I was very intrigued by their lifestyle. And one of these guys introduced me to IPL betting through WhatsApp. He said that there is this bookie on this WhatsApp group. You just tell how much money you want, and it's not about who wins. It's about every over. You need to predict how many runs will this batsman make. And you get to choose whether it's going to be below the 7 runs, above the 7 runs, or 7 runs. And at first I thought this is just this silly game. You know, why would anybody want to do this?
Right.
And he said, why don't you start once? And I said, okay, how much to start? Like 10 rupees, 20 rupees. Back then I was getting paid 5,000. My parents were sending me 5,000 rupees to pay for the rent and my food. He said the minimum price is 500 rupees. And that's 10% of my monthly,
And you did it.
you know, my monthly pocket money.
Right.
And he's like, if you win, 500 becomes 1,000. If you lose the 500 rupees.
Right.
So me and my roommate decided to split the 500 rupees. So we put 250 each. And then we went ahead.
Right.
And my roommate is a cricket expert. He's like, we are definitely going to win this bet. Let's go ahead. And we put it 250 rupees and we watched every single ball. Like our life depended on it.
There you go.
On the television channel.
There you go.
That's like watching the markets. And then every single second you're seeing what's happening to the markets.
Right.
And then as we deserved it, we lost the money. Right? 250 rupees gone. And then the Delhi friend was like, I think you should put more to recover that money. But we were like, I couldn't get sleep that night.
Yeah.
And then we went back to sleep just thinking about the 250 rupees that I lost.
Right.
250 rupees for a 18-year-old kid is a lot of money 7 years back.
I can imagine. Yeah.
And then the next day, we went again. Right? We're like, okay. And we went through that phase. I think we can win our money back. So then we put another 500 rupees, this time 500 rupees each. Because we not just recover the money, we need to be in a profit.
That's right.
Right?
Classic martingale strategy.
Correct.
Right.
So we did that, and this time we won.
There you go.
And now we've gone through the down and the up. Now we're like,
You're never stopping now.
game on.
Yeah.
Now every day we were taking bets on at least 2 to 3 bets every day. One on the overs and one on the final result of the match. So by the end of the week, I was 5,000 rupees in profit. Now this is a whole month of stipend made in 1 week.
Wow.
Right? And I'm on top of the moon. Now I'm thinking about the things that I can buy with this 5,000 rupees.
Right.
So what did I do? I got that 5,000 rupees and I started spending it.
There you go.
I went on these expensive restaurants that I could not afford. I could book an Uber to Indiranagar.
Absolutely.
And spend money on a club, all of those things. Now comes the next week. We're like, okay, we enjoyed this. Now I'm going to put more money and make more money. Things didn't go as planned this time, right? And I ended up with a negative money of minus 3,000. So 5,000 rupees what I won, gone. So meaning I lost 8,000 rupees and I'm negative 3,000 now. That's when I put the brake and said that this is addictive. I don't want to continue doing this. I'm going to run out of money. And actually one of my other friend who was also in the PG ended up with the negative of 22,000 rupees. He was getting paid same 3,000 to 4,000 rupees per month from his family.
5 months.
Right.
In
what
the hole.
did he have to do? He had to take loans from other friends. And it took him 1 year to repay all of those loans.
Right.
And that entire sequence of events traumatized me about gambling.
Imagine this being applicable to the 20 crore demat account holders, or let's say 11 or 12 unique demat account holders. This is happening on a daily basis. It's happening in the financial markets. It's happening with cricket betting. It's happening in the casinos.
Yeah.
It's happening. Now, the aim is not to avoid speculating. The aim is to have or to build a mental balance. Call it mental or emotional. I think it's a mix of both. But that is what is the difference between a successful trader or investor.
So let's get to that because I need to understand this now.
Sure.
But to start off, I want to ask you, what is that minimum amount of capital that I need to be ready to put into trading to be worth my time? Because a lot of people will be like, I have 10,000 rupees and I need to become a crorepati, right? Can I quit my job doing trading?
Yeah.
So a lot of people ask me this question, how much money should I put into trading? So according to you, what is that minimum money that I need to have saved up to even consider trading as a viable passive income source?
Got it. I'd say to start off, lesser the better. I think anything in the ballpark range of 10,000 is a good starting point. Not to start making money, but to get the feeler. It's like how you warm up before a batsman warms up before they start cracking away in the first few overs, for instance, or with anything, right? Before exams, you're prepping for it. So you must consider that first small little piece of capital as it is deployed for practice. It's really not to compound into some big multi-bagger or anything like that. But in order to quit your job or to earn a passive income that is equivalent to your earnings from a salary.
Assuming my salary is 50K per month, which is what the majority of my audience would be at.
Right.
How much should I have capital to trade?
North of 25 lakhs at least.
Okay.
At least. North of 25 lakhs. Because the expectation shouldn't be too high. And 25% is a decent expectation. Of course, traders don't aim for 25%, all right?
What do they aim?
Traders are always aiming to double their capital. It's a matter of when. Like some traders try to double their capital in a day. We call them gamblers.
Okay.
Right? They're generally buying options on expiry day.
Okay.
They're doing some wild stuff like that. I've seen this happening for the last 10 years of my life.
Okay.
Or maybe more. So that's one type. Another maybe wants to double his money every 3 to 6 months,
Okay.
right? And maybe another guy would want to do it in 2 years. So the rate at which people think of doubling their money is what drives them.
Double, I think, has really struck a chord with the Indian investors' mindset. Everybody is just looking at when can I double.
No, but those are also people with very little money in their bank accounts.
Okay.
It's the bottom of the pyramid that aims to double their money every day.
Interesting.
Yeah, that's the lottery money. Those who goes to the folks who go to the horse races.
They have now moved here.
I wouldn't say they've moved here. It's that mindset, the bottom of the pyramid in terms of their earnings or earnings potential. So they're looking for a lottery. So it's the lottery mindset that drives them, right? But anybody who deploys a respectable sum of money, respectable can be a year's worth of savings or 2 years worth of savings.
Okay. In a single trade or?
Not on a single trade.
Okay.
Trading in general, like
Okay. So
capitalize the account with that much money.
Got it.
And aim for anything more than 25%, because traders don't aim for less than that anyway. There's no point in trading if you're aiming for like 20, less than 25%.
Yeah.
You'd rather just invest in a few stocks and maybe that'll do the trick.
So you're saying if I need to consider trading as a full-time career, I need to have at least 25 lakhs?
Yeah, I'd say at least 25 lakhs. Because things are getting expensive. Yeah, and I have to say it like it is. Anything less than that is not really... I mean, I'm not saying it's worth your time. Of course, you can trade and also do your job by the side, which is what almost 99% of retail traders do anyway.
But do you think that's possible, to do a job and trade at the same time?
It's possible, but they ought to be less active because trading requires time.
So let's say I'm a job goer.
Right.
I work from 9 to 7. How exactly can I trade on the side? What are the things that I should be doing and what are the things I should absolutely avoid being a full-time, job going professional?
Right. Try to avoid micromanaging your intraday or short-term trades. Avoid having exposure in too many trades at the same time. Right. Try to avoid too much churning. Check the markets only when you have free time. Configure your trades at the beginning of the day.
So give me a step-by-step process. Let's say when markets opens at 9:15, closes at 3:30. So exactly how should I structure my day? Because I'm also at office, right? Maybe I enter office at 10 o'clock.
Yeah.
So what exactly do I need to do at the beginning of the day, middle of the day, end of the day? How would you do it? Let's say you are working at a company, you are earning 50K per month.
Yeah.
How would you live your life? Because you love trading and you want to start trading.
Yeah. So I would read the news before I leave for the office.
Okay.
Wait for the markets to open.
What news would you read? Any particular
Financial news. And everything from Financial Express to Economic Times. Watch Network 18. Just catch up on the news.
That itself will take like you an hour to read all of those things.
Not every day though.
Okay.
Sometimes newspapers are boring. So you just need to catch up on the main things which you think can move the indices. But yeah, it's not that hard to do.
Okay.
So finish reading the news, head to the office, allow for the markets to open and settle up till 10. Check the markets. If I see something interesting, place a trade.
Can you quickly break it down as to how I could know that without getting too much into the technicals?
First of all, one needs to be tuned into, okay? It's not like as though you can wake up one morning, download an app and start trading right away. Okay. That's a fool's paradise, right? That's what a lot of these influencers have also been preaching, like as though reading and becoming informed is not important anymore. All you need to do is click a few buttons to make money. No. So first of all, you have to be tuned in. You'll need to build some basic level of conviction on what moves the market, right? It can be an RBI announcement. It can be the budget. It can be war, for all you know. Maybe some sectors will move because of that. Maybe a disease can move pharmaceutical sector, like COVID, for instance.
Right.
Benefited a few companies. So you need to work with your insight and foresight to take a bet on a stock. If you see something move immediately or potential for a stock or an index to move immediately as a result of what you have observed, then take a trade either through futures, which is less popular these days, and most commonly options in the index, or just buy a stock, right? The key is to always have a risk management framework in place. The simplest is to put a stop loss. Some people just put a flat stop loss. You could also trail your stop loss to protect some amount of profits during the day. But the manual intervention should be as minimal as possible. So for example, to help with that, we built smart orders, right, which helps with trailing your stop loss, for example. Let's say if you hit a loss across one position, you can configure to exit all your positions in your portfolio so that you don't have to do it manually and waste your time and get all stressed during your work hours. So I wouldn't say it's perfect to trade when you're working. Ideally, one should not. But if you were to do it, this is perhaps the general way to do it. Another way to do it is automate your trades. Algo trading is becoming popular, right? And the future of trading is automation.
Using AI?
Either or. You can automate your trade even without using AI. You need to configure your preferences upfront. Let me give you an example.
Yes, please.
Let's say the market is Nifty today is at approximately 25,000. You set an instruction to buy Nifty at the opening price, right? Place a stop loss 1% below the buy price, and book profits if it goes 3 or 4%, or let's say 3% in your favor. Configure it to be an overnight trade, not an intraday trade. And if it goes 1% in your favor, trail your stop loss by 1% as the trade goes in your favor, which is if the market goes up. Right? If you pre-configure this, you can go to work and not check the markets at all. Right? That's a very simple example of automating your trade.
Is this possible today?
Of course, it's possible, and a lot of people are doing it.
Okay. Is it difficult to do this?
Not at all.
Like, do you need to be like having a background in computer science or something to do?
No, you do not. So today there are certain fintechs that make this available, and of course, the very detailed and complicated configurations would require some amount of knowledge with creating trading strategies, if not knowledge in computer science, because computer science knowledge can still be purchased, right, through somebody who can code it for you.
Now, what if, let's say, you are a good trader, right? And I want to follow whatever you're saying. Is there a way for me to copy what you're doing through technology? Is that possible?
It's possible, but it's not ideal at all. And it usually leads to disastrous outcomes.
Okay.
Because
copying somebody else's trading strategy is not ideal.
I don't think it's ideal at all.
Okay.
Because the strategy could be created for high risk takers, right? Perhaps the strategy requires 1 year of patience for it to play out, right? And so if let's say I'm a low risk taker and I can only deploy funds for 3 months, then ideally speaking, I should not be investing in that, because the guy who built that strategy has something in his mind which is suited to him perhaps, and not to everybody else. Second, let's say if there's one strategy which approximately 100,000 people follow, it's going to lead to crowding, right? It's going to move the markets in that direction. So the strategy creator can wield enough power to move the market.
Okay.
Because ultimately there are 100,000 people deploying funds doing the exact same thing that the strategy
Okay.
so recommends
that a
or
bad thing?
executes. It can be a bad thing, right? Of course it can be a bad thing. It can cause a short squeeze. It can cause a flash crash. It can basically lead to undesirable outcomes. But here's another thing that I would like to add to this.
Sure.
I firmly believe that trading is only meant for DIY. Advisory related trading is fool's gold. It's a terrible proposition, because trading is very time sensitive as an activity, right? Let's say I give you a tip. I'm an indoor advisor. I called you up at 9 a.m. in the morning and I gave you this tip to buy.
Right.
You were stuck in traffic. You saw the tip when you reached at, say, 9:45 and you place the trade at 10 after reaching your desk, the trade must have already gone. The opportunity must have
Gone.
gone. So what do you do then? You end up entering at the wrong price because the margin of error is really tiny in trading.
How quick should you be to?
Very quick.
Right. So let's talk about your own journey in trading. How did you begin your journey? You began at the age of 16.
Right.
Like, what were your building blocks to help you become who you are today?
Essentially, my curiosity about the market started because my father was once a businessman and he lost his life early because he ran into a huge financial crisis in the late 1990s. And also, my parents passed away at a very young age as a result of that. So I grew up orphaned and trying to figure out how the world works. So I started studying finance and economics while I was still in school. And so I was very intrigued by the system. And what can I say? My first investments were at age 16. I didn't have the money to invest. I borrowed some amount of money. I'd actually gone to do combined studies for my 10th grade exam. I think it was in the 9th or 10th grade exam with my friend. Just before exam, because you know how it is, right? When we were growing up as kids, you're not really studying. Backbenchers never study throughout the year. It's usually like 2 weeks before. So on one such day, I was there and my friend's father actually was retired and invested bulk of his money in the stock market. So he was investing in IPOs. And so I sat with him, I asked him a bunch of questions and he nudged me to try it out, right? And so I did. Then 2008 happened and I learned about it. Because some of the IPOs, thankfully, I didn't lose much. And if I had, I would have a really tough time repaying the money back. But I stayed the course. The vast majority of people back then, it was a horrible time, let me tell you. Like there were many stories of people killing themselves after the 2008 crash.
Wow.
It was a very grim and gloomy time to be around. And I stayed in. I continued to study the markets. I was a finance nerd for the most part. I came back to Bangalore after studying in Delhi for a bit, so I can resonate with the Delhi thing that you said earlier in the discussions. Huge culture shock over there. Came back to Bangalore, worked with a few brokerages. I worked with Zerodha for a fair bit initial days. I worked for a proprietary trading firm called Futures First. I was with some other traditional brokers as well. I was a typical equity advisor. And for a phase, I was trading gold and silver when they were really volatile during 2013, 2012 to 14, before I started Fyers. So I've been trading a long time. I've done all instruments, traded international markets, especially in commodities, to know how traders think overall. Because I deal with so many of them on a day-to-day basis, I can almost feel what they feel when they're making the mistakes. The same mistakes. It's the mistakes are the same, but the people are new.
So you mentioned that the mistakes are the same, right? But it's just a new set of people. What are those mistakes that people keep doing when they enter the markets, when they start trading?
One classic mistake is martingale. Right? Keep averaging and doubling up till waiting for your luck to turn around.
So you start with 1,000, then you go 2,000, then you go 5,000.
Waiting for your luck to turn around.
And that's a common thing.
That's very common, especially amongst beginners.
That's called martingale.
That's called martingale.
Okay.
That is something that I've seen forever, and I almost get tempted to, especially in the days that I used to also do customer support at Fyers, I used to get really tempted to tell them when to call me to deal an order. I used to then don't do this, but we were catering to DIY only, so my role was that of a pure execution broker. So I would do what they asked me to do. It's like you can't, like a retail trader is also limited by bandwidth. Doesn't have a team trading with him, right? It's quite a lonely activity in itself. You're sitting in front of a computer. So what tends to happen is that they don't journal their trades, right? That's the equivalent of driving without looking into the rear view mirror, or Another analogy is maybe lifting weights without tracking your progress. This is like that. It's like taking it with the flow and not really measuring your results in any way. So they tend to go haywire.
Apps don't do this automatically, where
The apps provide you with reports. So you have all the data to analyze, but most people don't have the patience to sit and do it. Look, everybody wants 10x returns, but they don't have 10x patience. That patience part is missing. The main edge in trading is being able to handle boredom, right? You have to be prepared to handle boredom because trading is not supposed to be exciting. Profitable traders treat trading like plumbing, like they're fixing leaks. And that happens with analyzing your performance post-market hours. So trading is never 9 to 3:30, right? In equity markets, it is 3:30 to 9.
where you're analyzing what happened.
Yes. And planning the next day.
Got it. So now let's come to how exactly should I manage my portfolio? Let's say I have a portfolio of 20 lakhs of savings. How exactly should I invest my money? By looking at every asset class, right? On one side of the coin, there are people who will put the entire 20 lakhs in a house and then call it a day.
Yeah.
Like I have a 1 crore house now. Let's just be paying the EMIs and building my house.
Yes.
On the other end of the spectrum, there would be someone, I'll put all of this money in stocks so that I get richer and I become a crorepati in the next 5 years. How exactly should somebody look at their investing strategy?
Again, there's no general rule, right? Everybody has their own goals.
But if the objective is to become financially free,
Like fire at 40.
that seems like a good target to have.
Fire at 40, then almost everything in equities, stocks.
100%.
Yeah. Like, think about this. The richest people in the world are the ones who have taken the riskiest bets. And those riskiest bets are usually their own businesses, right?
Right.
If you take my own example, over 95% of my net worth, if my startup is valued appropriately, that is in my startup.
Correct.
Is in Fyers, right? So my wealth comes from the value of the company, right? And it was a concentrated bet. If you think about it, just one stock. So you can't make money in 100 stocks unless you're a very good trader, right? Like if you look at the investment framework of highly diversified investors, like venture capitalists or angel investors, for example, you will often see that they have something like 100 investments.
Right.
Why do you think that is? Because they don't have conviction in any one company for it to represent a big enough chunk of the portfolio, right?
Right.
Because they're scared of losing, and hence their expectation of that one company is 100x to be able to move the needle at a portfolio level.
Right.
So it doesn't have to work like that, actually, especially if you're investing in public markets, because these companies are past that survival stage. Right? Many of them are not going to disappear. Most of them will not disappear overnight. So the idea is to build conviction and invest in them early, invest a lot early and keep investing early and keep investing throughout. That's the way to become financially free. But the concept of fire is a whole new different debate. But if you want to be able to live life comfortably, like for example, your 1 crore is not going to be worth 1 crore 10 years later, obviously, right? So your returns have to be inflation adjusted, and just beating inflation is not good enough. And just because inflation is, say, 3% now.
I think we can assume 7% for people watching.
Yeah, but you never know. You see, the problem is that we make too many assumptions about what the future may be. And these assumptions are very naive in general. Like you take a historical track record and say, okay, GDP growth is X and stock market growth is Y and inflation is this. And if I make like 5% over and above inflation, I should be able to finance my lifestyle for the rest of my life. There are so many variables that are uncontrollable. Number one, we don't control the country's output. We don't control valuations in the stock market. We don't control how long you live for, right? Like you never know.
Yeah.
With, let's say, uh, advances made in healthcare, you could live as long as 100. But if you retire at 40, would you have enough money to live till you're 100? Right? It's just, I think, it's just fire as a concept is very naive. But that aside, if one has to achieve financial independence over the next 10 or 15 years, then it has to be in a very aggressive asset class, and within that, a very concentrated category
Okay.
in which there is conviction. I'll go as far as to say that there is no chance. The guy who invests in 5 different large cap funds, for example, or another risk averse person who wants to fire, for instance, has large cap, hybrid, debt fund, and all of this stuff, will never be able to become financially free by the age of 40, 45, 50.
Assuming they're not earning in crores.
Assuming they're not earning in crores.
So either you increase your income to make like
That goes without saying, actually.
right?
Yeah, that goes.
Either your income is like 50 lakhs plus, then you can have a diversified approach. But if your income is like in the 15, 20 lakh range,
Not really. No. 50 lakh plus does not call for a diversification. Look, diversification may be necessary, but how much is the key question here? Like 50 lakhs a year you're still going to incur a lot of expenses. Net savings of 50 lakhs is going to be tiny. Like if you look at the household savings rate in India, it's shrinking. And if you, and the household debt is rising. This is a linear trend, right? So it's becoming more expensive to live properly. And that's not, that trend is not going to stop. It's not like as though someone who, for instance, buys an Apple laptop or an iPhone is going to downgrade to a feature phone.
they're not going to do that.
They're not going to do that. The whole idea is to be able to live well.
Yeah.
And regardless of whether it is 50 lakhs or 5 crores, the goal is to be diversified, but just enough. Another thing, our understanding of risk is very subjective. Now, if you want to retire by, say, 40 or 45, it is risky to diversify. Because it's super risky. You retire and then you don't have the means to support your lifestyle. You're actually putting yourself in a soup.
Fair. So what you're saying is that to become financially free at an early age, you need to invest in assets which are going to be risky. If you don't take risk, then you're not going to make a lot of money.
Yeah.
And the fastest ways that people have made money are by investing in businesses.
Yeah.
And stocks are businesses at the end of the day.
Yeah.
And it's not about investing in 100 different stocks. It's about having conviction on a few stocks, like a concentrated portfolio of, let's say, 5 to 10 stocks, and invest early when they're young, and then ride the wave.
And continue riding the wave. Continue investing as you ride the wave.
So I've heard a lot of reputable figures in the United States, like a lot of famous US investors, say that a retail investor is better off just investing in the index,
Right.
because it's almost impossible to beat the benchmark, because it takes an obscene amount of research and work, which is just not possible for a retail investor. What is your thoughts on that? Do you agree with that? Do you think it's kind of pointless for a retail investor to even get into doing stock research by themselves and investing in individual stocks? Might as well just invest in the Nifty 50 index.
Not at all. I think the efficient market hypothesis is what you're referring to, is that markets are always efficient and it's impossible to beat the markets.
That's what they
over
think
the
in the West.
period of time. It's a theory, the efficient market hypothesis. And it has been disproven, arguably disproven. But if you ask me, I believe that it is possible to beat the markets. There are many people out there, retail institutions, that are beating the markets, and it will continue to happen because markets are not efficient and they will never be efficient because the participants are inefficient.
Interesting.
Right? Because the markets are comprised of people. They come in with different goals. They come in with different perspectives. Right? They come in with different amounts of money. They come in at different times. Right? And even with the same information available to everyone at the same time, you still have inefficiency because of how we all are. And in general, markets are driven by herd mentality. So if something's working, for instance, if you notice what happened in the defense sector, rallied quite a lot, right? India wasn't in any war back then, was it?
No.
No. People didn't know why they were buying it apart from the fact that it was going up. Recently, India had this Operation Sindoor against Pakistan.
Right.
But the stocks are down quite a lot from their highs. So it's the herd mentality that drives the markets. If the markets were efficient, they would react very differently.
But why is that so? That you just brought up an interesting point that even though Operation Sindoor happened, India versus Pakistan was happening. Everybody was looking like, this is going to be a war situation. Why did the defense stocks not rally? Because logically, that is what people would think, right?
Well, they're trying to go up in the second leg of the rally. But the reference point has changed. Meaning that the defense stocks had already rallied so much that when it was time to finally expect a capacity expansion of the defense sector as a whole, the market had already knowingly or unknowingly discounted much of that growth.
Interesting. So now if I have to talk about the future, imagine this. I'm coming to you and I am somebody who can invest 20,000 rupees per month as an SIP.
Right.
Now I want to put this into stocks. But you tell me, how do I divide the money across different sectors?
In terms of the number of sectors to invest in, I think for the goal of creating massive wealth, like you mentioned, is to not have more than 3 or 4 sectors, right? Take exposure to thematic funds if you want to do it through mutual funds.
Okay.
Right. Try to find opportunities in the bigger trends, the bigger long-term trends in the economy. Like, for example, defense spending is going to become a long-term trend. India will continue to spend a bigger portion of the GDP on defense because it's important. You will see the manufacturing sector improve a lot because everyone's betting the government really wants to expand its manufacturing capabilities. They're trying their best to resolve the labor laws and the logistics problems that we currently have, which make us extremely incompetent. But all these are decadal bets. They are not for this year or the next year.
True.
So you have logistics, manufacturing, an industry like chemicals, which is so small. There isn't even one large cap in that sector.
Why is chemicals important?
Because we use chemicals in almost everything around us. Like everything, even in this room, is made up of chemicals. And so the people who manufacture specialty chemicals will thrive in the country, obviously, because they're the components, they're the ingredients of the products that we use today.
So right now it's coming from outside India?
Yes, but also now India is specializing and, they're building our capabilities. And the sector is going to grow because urban consumption is only increasing. So typically when a retail trader or investor thinks, not just in this sector, but in any sector, they tend to think the OEM in automobiles or the phone manufacturing brand or the FMCG product, but they ignore the supply chain. They ignore the component manufacturers, for instance. This stuff is important, right? That can only come with level 2 effort.
Level 2 effort.
Yeah. Level 1 effort is reading the news. Level 2 effort is digging into the details. Read about the company, visit their website, download their annual report, read it, right? Do that. If you're watching podcasts, watch podcasts of serious people. Like, don't waste your time watching rubbish, stuff like that. You know what I mean? So yeah, these are just few of the things that I mentioned. And I also think the banking industry is going to expand quite a lot because today, India's companies, especially the private companies, are very deleveraged. Right after what happened in 2013 and then COVID in 2020, all sectors went into a deleveraging mode.
Meaning even if you getting rid of loans.
Yeah, they started paying back loans and just to protect themselves, right? And now with inflation at 3%, with domestic demand, which is on the rise, but it will accelerate further as income of the citizens go up in general. Per capita income is going to go up with employment, and just even if nothing much changes, it's going to go up, right?
Yeah.
So you're going to see a lot of money being made by companies. And so for them to be able to cater to the demand, they need credit, and and bulk of the credit will have to come from banks. And so there will be a credit expansion over the next few years. I'm hoping that it will be a linear trend at least till the turn of the decade.
Okay, so you talked about the good sectors. What are the bad sectors which I should avoid? Because they don't have a, you're not going to be, you can't expect outsized returns from these bad sectors. What are they?
Like oil companies, any like legacy traditional energy companies, be it power producers.
What about automobiles?
I actually have a controversial opinion about automobiles.
Please.
I think that India's roads need to improve before we can produce automobiles at the scale. Like India currently has 40 vehicles per 1,000 people. China has 800, US has maybe more than one per, so it's much, much higher.
Yeah, I mean, like what Europe does is phenomenal.
Like China, for example, Japan.
I've never been to China. How is it?
Oh, it's an amazing country. The infrastructure over there is just, it's everything feels like a mega structure.
Everything is part of an organism.
Yeah, everything is 10x. Right, a metro station feels like an airport. Yeah, so there was a point when I was a commodities trader, and I thought something must be wrong with the numbers when they said that 50% of iron ore, for example, is being consumed by China, or north of 40% of aluminum is being consumed by China. How can this be? How can one country consume that much? Right? I was still very young and impressionable, but when I went there, I got to see how much they have built. Like if you're on a train from Shanghai to Beijing, it takes you about maybe 3.5 hours, maybe 4 hours, right? And it's traveling at almost 400 kilometers. And I think it's 1,500 kilometers, and the number of buildings, you can barely see flat stretches of land. All you see is building in the entire journey. Like, and it's just mind-boggling to see how much they have built over time. It's like they have this obsession with infrastructure, and that's quite visible.
So currently, when I look at the world, I'm not just looking at India, because today I have the capability of investing outside of India as well. Correct. Now, if I look at the largest players in AI, I'm going to exclude the private companies. I'm just going to look at the public companies because I can invest in that. Right. I have Microsoft, Google, and Tesla. Would it not be a smart decision to blindly invest your money in these three companies, because it is so obvious that nobody else can catch up to them, because they are pumping billions of dollars, and even Facebook for that matter. In fact, I heard this news that Facebook is offering $100 million joining bonus to the core team of OpenAI to leave OpenAI and join Facebook. So when I hear this kind of stuff happening, right, and also seeing the impact of AI in my own business and how disruptive it has been just in the last 3 months in terms of cost cutting and innovation, it just makes me feel like, why am I even bothering investing in other sectors?
But just hold that thought for a second. You said that it is disrupting even your own business in some way, maybe positive or negative. Don't you think that is applicable to your peers as well? The same tools that you are using can also be used by your peers. Maybe you will use it better. That comes down to skill.
No, I agree. I'm saying I want to invest in those companies which are making other businesses more efficient and better, because every business will need to incorporate AI into their business, else they will become obsolete in the next 5-10 years. That's what I believe. Right. Especially if you are in the digital business. If you're a physical business selling newspapers, or if you're selling, I don't know, shampoo, then might not affect you. But if you're in the digital business, I think AI will become inevitable. And the companies which will enable that will automatically become rich. So shouldn't we invest in these stocks?
Not necessarily. So one thing about any gold rush, I'm calling this a gold rush in the context of how people behave, is that when something becomes extraordinarily popular, very popular, captures the imagination of every living being on earth, so to speak,
Yeah.
right? That will attract competition. Just because there's OpenAI doesn't mean that others aren't going to surface very soon.
Right.
So typically, this is like an iceberg. Like what you see on top with AI is an iceberg. Underneath that, there's a lot more, which will come to surface later on. Doesn't necessarily mean that it's going to become monopolized by 1, 2, or 3 companies. Like for instance, with NVIDIA and semiconductors, they really don't have a monopoly. The Chinese are making it in a cheaper and perhaps better way. Candidly admitted by the CEO of NVIDIA, I think. So the thing that I've noticed from a crowd psychology standpoint, whether it is a crowd of entrepreneurs or investors, wherever there is a big hype and where the results are yet to be seen in the future, nobody really knows what's going to happen. Very often, it does not happen in the way that people expect. But what I'm saying is this. The public is most often wrong about the future. Like the wisdom of the crowds is not always. The wisdom is not very high, let's just say.
Okay.
And the reason is because it is dominated by herd behavior. It's not dominated by rational thinking.
But what about the VCs who are pumping in billions of dollars in the sector? They are also they are typically considered the smart money, right?
Not necessarily. Why do you think you think they don't go wrong? In fact, their hit rate is really, really low. Like the fact that they want 100-bagger shows indicates what their hit rate could be, right? Because most of their other bets are going.
So you're saying that the sector is going to benefit, but it's not yet sure who is going to win.
Exactly. The point is that an investor should bet on change, not on a static outcome.
Okay, so you're saying that there is promise.
Yeah.
They're probably going to grow up,
Yeah.
but the valuations are not making sense right now because of the herd's hype.
Right.
But if you had to say, what are those 3 things that Fyers do that other brokerage apps or other trading apps don't have? What are those things?
We have a very innovation-focused DNA. Like we like to do things differently. There are a lot of first to industry that Fyers can be associated with, right? We're the first to bring TradingView, integrate TradingView in India.
What does that mean? Integrate.
So TradingView is a very popular charting platform. It provides market data and gives you visibility into what's happening in markets around the world.
Okay.
Right? It was accessible in India only to view, but you couldn't really trade on it. So we were the first to kind of make that happen in India. We were the first to democratize Algo trading. We offered free trading APIs. So there was this growing community of traders in India that were hoping to automate their trades, but they weren't getting access or their access was too expensive. So we democratized that. We made it free. And in 2 years, it just exploded and a lot of fintechs blew up using our APIs. So that happened. Today, we offer a lot of analytics and information to make informed decisions for traders. We have smart orders, which no other brokerage really has. So smart orders essentially allows you to operate better as a trader. So for instance, let's say you want to exit all your positions if your profit target is hit, right? You would have had to manually do it if you're using any other app. On Fyers, you can just configure it and it'll happen while you're at work or something. So stuff like that. We like to innovate. We also introduced India's first AI screener.
Okay.
Right? So you can prompt something which would take you 3 hours to find. It'll give you the result in 15 seconds.
Wow. So you can prompt it and screen the stocks which are fulfilling that prompt.
Yes.
Interesting.
And we're expanding that. We're making it better every month.
Okay. All right, Tejas. Time for the rapid fire questions.
Awesome.
One money advice you believe in, but most people don't.
Concentrate instead of diversifying.
Okay. A financial myth about trading you want to kill forever.
Yeah, the majority will continue to lose. There is no way that a competitive endeavor will have majority winning.
One startup idea you would pursue if not Fyers.
That's a tricky one. For a person like me, I think it's maybe something to do with health, to help with the sugar addiction that we Indians have.
Got it. One book or person that changed how you look at money.
The Origin of Species. It's a book written by Charles Darwin on survival.
Of course, yeah.
So I look at money more as a means to an end, and how money is used as a fuel in order to survive, rather than an end in itself. So it's my angle to the concept of being able to survive.
Got it. All right, guys. That brings us to the end of the podcast. Thank you so much for watching till the end. I'll see you in the next one.